The trends in the markets right now is really that we're seeing good performance across almost all the asset classes.
And now we're actually seeing enough progress made on disinflation that central banks have begun easing. And I think that is something that will continue going forward.
But so there's always going to be challenges and there's always going to be risks.
We have a new administration coming in. And certainly there are some pro-growth policies there, but there are also things that concern me.
There's going to be a lot of changes in policy, meaning taxation and everything else, and fiscal policy. This is going to be the next big challenge for us in 2025. When we start to think about asset allocation, we usually think across three asset classes: equities, bonds, and alternatives. Equities, I think currently standing around a 22 PE multiple is probably a fully valued market.
But in fact, if we were to look at valuations, there are some real attractive PE ratios out there. They're just not in the mega cap tech names. We can find far more attractive valuations in the smaller cap space, in cyclicals. We can also find more attractive valuations outside the US, in particular UK equities, but also European equities, Japanese equities, and emerging markets equities.
The equity markets are pretty straightforward in terms of understanding, but the bond market seems even more fully valued than the equity markets because people are already expecting the Fed to cut interest rates. Interest rates have already moved in advance of those rate cuts. So that element of return, what we call duration in bonds, has already been placed into the marketplace. Now, sure, it can fluctuate over time, but by and large, it's already in the market. So what's left over is the spread in bonds, particularly in corporate bonds and credit high yield. The spread right now in bonds, credit spreads in bonds, are very tight at the moment. So what that means is that the excess return that you could get over US Treasuries is very compressed and very narrow. And it makes us question how much valuations have increased in the bond markets. Now, that doesn't mean that bonds won't be a good investment, but what matters is how you invest in bonds.
I think there's significant opportunity in high quality, high yield, just given how resilient the US economy has been. Of course, investment grade credit looks attractive, municipals look attractive. If we go outside the US, emerging market bonds look attractive. So now, really, in the last year or two, has been the most attractive time for fixed income in many, many years. Another area of opportunity is alternatives.
Some alternatives have gone through a corrective phase really at the beginning of this year and actually have better valuations.
Area of opportunity within alternatives is private credit. Now, that's a space that has grown a lot in recent years because banks have walked away from a lot of this kind of lending. Now, we also have real estate. Historically, real estate has been a lower correlating asset class, so it can offer diversification benefits, and it actually can offer significant income benefits.
So all of this together suggests that if we look at stocks, bonds, and alternatives and create a balanced allocation across those three, I think we can have a durable, very stable portfolio, but there are risks. Right now, the US is running a deficit to GDP of about 7%. This is very high. The other risk that exists right now is the narrowness of the market, meaning that a lot of the returns in the equity markets have been down to just a handful of stocks. It might be long-term healthy, but in the meantime, this could be very disruptive.
Now, investors also need to be worried about a resurgence in inflation. If 15 to 20 million people are deported, many of whom are part of the labor market, we could see a very significant increase in wage growth, especially in particular industries. That could contribute to significant inflationary pressures. So all those things are risks to consider as we head into 2025.